Yeah, Aaron, we're gonna get started now. As you know, today we're gonna be covering off of topics, Spencer and myself, about new trust reporting rules and essentially what the changes are from these new proposed legislation that was um, released in August of 2024. First, just wanted to mention that throughout the presentation, we're going to be providing different examples of bare trusts or trust reporting arrangements. Um, they're more generic, so basically every circumstance that you're under, like your own specific circumstance, might be um, more technical or different than what these generic examples are. So you should always discuss your specific situation with your lawyer and or accountant to make sure you understand if there is a filing requirement or not. So as I mentioned today, we're gonna first off just briefly discuss what the purpose of a trust is, go over what is a bare trust, discuss what has changed, go over what penalties might be if you don't comply with tax filing requirements for trusts, discuss the timeline for these new rules related to bare trusts, go over the proposed changes from 2024 in August, and then discuss some examples of bare trusts that might still have filing requirements and some planning for that you can take in 2024 to remove these filing requirements. And then at the end, we'll open the floor to any questions that you might have. So first off, I'm kind of covering what is a trust and what is its purposes. There is a number of purposes to set up a trust, either could be tax reasons or non-tax reasons. So you might set it up to split income amongst your family to save some tax in your overall family group. If you're selling a business that might qualify for the lifetime capital gains exemption, you're able to multiply that if you use a trust to hold those shares. You can also have some creditor protection as the trust would hold the assets rather than yourself personally. Can also use it for estate planning purposes, so to pass on the wealth that's in the trust to the future generation with some flexibility and not holding those assets personally to minimize like your terminal tax liability. The same thing with probate savings. You can save on probate with assets held in the trust generally, as they're not held by you personally when you pass away. And then there could be other legal reasons why you might want to set up a trust. And we refer to a regular trust as just a normal kind of trust that's not a bare trust, just as a term for this presentation. So what is a bare trust? So basically a bare trust is an arrangement where there's one individual essentially act who would be called the trustee acts as an agent for the beneficial owners of the property. So those who would actually benefit from the property, known as the beneficiaries. Um, the trustee really doesn't have any role other than they just hold legal title to that property. So say a house, and they only make action whenever the beneficiary directs them to do it. So if they're the beneficiary might tell them to sell the property, then the trustee would go and sell the property. But without that direction from the beneficiary, the trustee would not take any action. Um, a bare trust is not taxed as a separate entity. Um, Basically, for income tax purposes, the taxation remains with the beneficial owner. So the beneficiary technically still owns the property for tax purposes. So they would report any income or capital gains related to that property as if they owned it themselves. And there's no actual reporting within the trust for any income or gains related to that property. And then just a couple examples of what bare trusts are to try and show you what they are. Basically, it's when the legal owner differs from the beneficial owner. So example one is if a child buys a home and the parent needs to be added on to the legal title for purposes of the child receiving a mortgage from a bank. The parent didn't contribute any funds to the purchase price, so they're just on there basically for mortgage purposes. So basically, the parent would be holding their portion of the legal title as a bare trustee for the child, as the child would be the 100% beneficial owner, but the parent is just on the legal title and would just act if the child told them to related to that property. Another example in a corporate context is if a corporation holds the legal title of the property, but then the actual beneficial owners is a different corporation or an individual. So in this case, we say 123 Bronson Avenue Inc., a fictitious corporation, is holding legal title as bare trustee, but the actual beneficial owners would be a different corporation or an individual who would direct Bronson 123 Bronson Avenue if they wanted to sell the property. I'm going to pass it over to Spencer here to discuss what has changed the tax
Thanks,
filings.
Josh. So the main question is, why are we here today? So what's changed, and what's important to everyone on this call? So historically, if we look back prior to 2023, only certain types of trusts were required to file a trust income tax return. Those were generally our regular type trusts. But more recently, in particular, 2023, bear trusts were included in the scope of what types of trusts needed to file tax returns. So each year, these bear trusts would now need to file a return in addition to the regular trust. Historically, that was never the case, and bear trusts were not obligated to file at least a trust income tax return. As part of that filing, there are additional disclosure requirements for both types of trusts, so the regular trust and the bear trusts. And those disclosure requirements require that the trustees report information on the beneficiaries, the trustees, and the settlers, and some other individuals involved in the trust. So the scope of the reporting was also increased as part of these rule changes. When we talk about penalties, so what happens if we don't actually file the returns? So as part of these rule changes, additional penalties were added to the Income Tax Act. The most important being this $25 per day late filing penalty, and that's up to a maximum of $2,500. And this penalty would apply even if there is no tax owing in the trust itself. And so that would be the case for pretty well all of the bear trusts. And so if the bear trusts didn't meet their filing obligations and filed late, simply filing that disclosure form late would have resulted in this potentially, $2,500 penalty. So that's quite substantial in the grand scheme of things, especially if there's no income tax owing. This penalty is on top of the potential penalty that could apply for regular trusts if there were income taxes owing in those trusts. So definitely important to understand and ensure that you're meeting the filing obligations for the arrangements in your family or in your corporate group. In terms of the filing deadline for these trust returns, they are due 90 days after the year end for the trust, and the vast majority of trusts will have a year end of December 31st. So usually that pegs the deadline around the end of March. Okay. There are some more extensive penalties, as you can see on the bottom of the slide, but those would only apply in very specific circumstances. As I mentioned, way back when in 2018, the federal budget came out with new rules that they had intended to implement for the 2021 tax year. Of course, in 2023, that was the first year that these rules came into place, and so there were a number of delays along the way. Originally, exclusively regular trusts were required to file tax returns, and only if they had taxes payable or capital gains or some other specific requirements. And bear trusts, as I mentioned, were completely excluded. So they increased the scope, and pretty well all regular trusts need to file, and also bear trusts need to file as well. Of course, immediately before that 2023 tax year filing deadline, which would have been March of this year, 2024, CRA came out and said that they are providing an exception to the penalties for bear trusts that would have needed to file for 2023. So this exception only applied to bear trusts and not regular trusts. So all regular trusts still needed to file for 2023. But for bear trusts, there was, no technical penalty that would be associated if the return was filed late. So in essence, it was an exemption for 2023. Fast forward to August of 2024, and as Josh has mentioned, the government announced additional amendments to these rules. There was quite a bit of backlash in the community and Canada, at large, in terms of the widespread scope of the Bear Trust rules that were established for 2023. So the government took that and provided some amended rules, and the scope of those amended rules are, much more narrow. And importantly, assuming this legislation is approved, the filing requirement for bear trusts is not present for 2024. Bear trusts will be required to file for 2025, and as I mentioned, the scope of those rules are much more narrow. So you'll definitely want to revisit, whether your bear trust arrangement is required to file for 2025. So that leads to the question. As I mentioned, there's draft legislation that was introduced in August of 2024. Of course, it takes quite some time for legislation to be enacted by the government. And during that time, the legislation is what we would call draft legislation. So it's not been enacted, but it's been, announced and it's in draft form. And so a question you might have is, do we actually need to act on this legislation before it's actually become law? And so this is quite common actually for income tax legislation in the sense that the government will announce rules that have an effective date either today or sometime in the future. And it will take the government obviously time to go through their formal processes and actually, make that legislation law. And so when it comes to income tax legislation, usually we do need to act on the draft legislation even before it's been enacted. So as it stands right now, the legislation that's, been drafted and issued in August and it was slightly revised in September, we do need to assume that legislation will be, passed into law as it's been drafted. So what we're talking about today is just, based on draft legislation. So there is a possibility that it changes. But largely, we're assuming it's going to be enacted as drafted. Trust filing requirements. So this is kind of a summary of where we were at for 2023. Those top two bullet points were really the only requirements to file prior to 2023. So if you had a regular trust and there was no tax payable or no capital gains, then you may not have had a filing requirement, even if it was, what we call a regular trust. However, in 2023, they came out with this, longer list of exceptions, which required not only do you need to not have taxes payable and no capital gain, but you also needed to meet one of these kind of limited exceptions. And this applied for regular trusts and also for our bear trusts, which is where the scope of the rules were expanded quite broadly, as I mentioned. The two most relevant exceptions here are the top two. So if you have a trust, whether it's a regular trust or a bear trust that existed for less than 3 months, and you met those two requirements at the top, then that trust may not have a filing requirement for the year. And then the second bullet point, as I mentioned, is the fair market value of the property that the trust holds is worth less than $50,000 in Canadian at any time during the year. So you would look at basically every single day, and if the value of the property exceeded 50,000, you would not be able to rely on this exception. There are also only certain types of properties that could rely on this exception. So if it was real estate, it doesn't matter what the value was, you couldn't rely on the $50,000 exception. So it was very limited in scope.
So where we're at now, with these new 2024 proposed changes, we're going to go through some examples of where previous exception might have applied, like one that Spencer just mentioned, and how it's been updated, or there's also some completely new exceptions and what type of bear trust arrangements those might impact to no longer require a filing requirement. So Spencer was just talking about that previous rule exception where only certain assets were held by the trust and the fair market value of all those assets were $50,000 or less throughout the entire year. That was basically limited to cash, investments on the stock exchange, or units of mutual funds. So pretty limited scope. If you had just one asset not in that criteria, then you could be required to do the bear trust filing under that old rule. So in these proposed changes, the big change they made is basically the $50,000 limit still applies, but now they basically said any assets. So instead of limiting the type of assets, it could be like if a real estate property is less than $50,000, or if you hold shares in a private company and the assets are less than $50,000 within a bear trust, then now this new proposed exception would apply, and you likely wouldn't have a filing requirement for the bear trust. So like I mentioned there, this might cover off a lot of these in trust accounts where parents open up a bank account for a minor child and they might hold some GICs, which weren't previously exempt. Um, and if, as long as all the assets in that account are under $50,000 throughout the whole year, then they should be exempt under this new tax filing requirement. And as well as like small trusts, so they could just be holding, like even if they hold private company shares in trust for a kid, for example, but those shares aren't of much value, they're less than 50,000, then those could also be exempt as well. So definitely a lot more trust could be exempted by this, just given that they've changed it to any assets instead of only certain assets. Another previous rule that was updated a bit, so there was trust accounts that usually like lawyers would hold for their clients. And basically, if the funds were pooled all into one account, then they were exempt. But if they had separate accounts for each client, then basically there could be a filing requirement before if they didn't meet some other exemption, such as that $50,000 exemption. So if the trust account is separate for each client and they held 50,000 less than $50,000 of cash, then you would have been exempt under the old rules. But if it was higher than the 50,000 and it was in a separate account, then there might have been a bare trust filing requirement in that sense. So the proposed change is basically that they've now updated that limit for these separate accounts to $250,000. Um, so hopefully that would exempt some more of these kind of trust fund accounts held by lawyers or realtors that are required under their rules and legislation of the law um, to be exempt now. So just a bit more flexibility and giving a much higher dollar limit than $50,000 is that's quite low probably for most separate accounts. Now I'm going to get into some new proposed filing exceptions. So these are ones that wouldn't have existed before. So they're kind of brand new exceptions, and then discuss what arrangements would be impacted by this. So this first one is a bit wordy, but basically, if each trustee is an individual and each beneficiary is an individual, and the beneficiaries are related to all of the trustees, and then in this case, there's a restriction on the type of assets. So similar to the old $50,000 exemption, except in this case, if all these assets do not exceed $250,000 Canadian at all times throughout the year, and they hold assets such as money, GICs, investments on a designated stock exchange, mutual fund trusts, etc., then they might be able to be exempt basically from these bare trust arrangements. So it gives a bit more flexibility on some bare trust arrangements that wouldn't require a filing. Again, these in trust accounts held for the parent or child now, usually like the parent and the child are going to be the parent will be the trustee and the child will be the beneficiary, so they'll be related to each other. And previously, you could rely on that $50,000 exemption even after it contained all assets. But now, if you still meet these specific assets that are held in there, which is mostly the case in an in trust account, that's kind of bumped up to $250,000. So hopefully, that should cover off majority of these in trust accounts that previously did have to file bare trust um, tax returns. And kind of the same in the reverse. A lot of times, parents will add their adult child onto a bank account trying to save some probate. Um, and as long as that bank account then is under $250,000, it should generally be exempt from bare trust filings. So just some expanded value for those accounts now to try and get rid of some of these filings that previously were required that weren't really the intention of finance to capture with these reporting rules. Another one's related to real property. So if there's a real property, so a building, like personal use property, basically, where all the legal owners are related individuals, um, and at least one of those legal owners could designate the property as their principal residence in that tax year, then they would be exempt. Biggest thing is like, could they designate it as their principal residence? So essentially, if one of the legal owners and they are all related, they've lived in that property for part of the year, then they should be able to be exempt under this exception. So they don't actually have to claim the principal residence exemption for that tax year on a future disposition of the property. So just basically if they would meet the criteria to claim it as a principal residence in that year, then it could be met. A key takeaway on this is that there's no dollar value associated. So that's pretty good that there's no associated because obviously if it was like $250,000, a lot of these real properties would probably still be captured because properties are well over that value in most instances. Um, so some of the arrangements that this should exempt now are basically where a principal residence, so such as a home or a cottage, where the legal owner lives in the property, um, is where that example we gave earlier, where a parent might get added on legal title with the child for mortgage purposes. So the child presumably lives in that property and they are one of the legal owners. So they should be exempted under this exception now. And then also there's the reverse where the adult child might get added on to the title of their parents' home. So the parents could claim the principal residence on their home or cottage and they're still on legal title. So it should exempt a lot of these previous filing requirements related to real properties where a bare trust existed. I believe this is the last exception. So basically where a general partner that holds property as an agent for a partnership and that partnership has to file a T5013, so a partnership tax information return, then those would be exempt. Usually a general partner might hold the legal title for the benefit of that partnership. So before there was probably a bare trust filing requirement related to that. So um, now majority of these partnerships shouldn't have to file a bare trust T3 filing in addition to a T5013 for the partnership.
So Josh has gone over old structures or arrangements that are no longer caught. I'm going to quickly talk about some structures that continue to be caught. So this would obviously apply for 2025 when bare trusts are obligated to file a return again. So Josh had kind of discussed a bit about adding an adult child or parent on a investment or bank account as a joint owner. So, of course, if it's below that $250,000 exception, you should be fine. But if you are above in terms of the value of that account, then it's likely that you have certainly a filing obligation in that case. There is some ambiguity in example two here. If the account is multiple accounts, so let's say there's three investment accounts, they're all, $100,000 in aggregate. But I should say separately, and in aggregate, they're $300,000. Then the question becomes, well, is that one trust for tax purposes, or is that three separate trusts? And of course, if it was three separate trusts, they'd all separately be below that $250,000 exception. So in this case, you may choose to file a tax return anyway, just to be safe. As I mentioned, those penalties can be quite steep. So you would file one return on the basis that those three, accounts or all one bare trust arrangement, so to speak. Similar vein, if an adult child or a parent is added on joint title of anything that is not a principal residence for that individual, so something like a rental property, we know that's going to be considered a bare trust arrangement. In this case, there's typically no exception that we can rely upon. Of course, if the value of that real estate is worth less than 50,000, we can rely on that exception. However, in general, most real estate is going to be well exceeding that $50,000 exception, especially if it's a rental property. So once again, you'll be caught by these filing requirements. Corporation holding legal title to a property as a nominee. So this was one of the very first examples that Josh had kind of talked about. So certainly this is a bare trust arrangement. There's a document that specifically outlines the terms of the arrangement. And so that arrangement would be required to file a trust income tax return. And of course, in this example, because the bare trustee is a corporation, it would also be required to file a corporate tax return. So there are additional filing requirements for that arrangement moving forward. So we're not quite into 2025 yet, so there might be some opportunities to do some planning in 2024. The most important, I would say, is reviewing arrangements that you and your family have and consider whether there's anything we want to do to either wind up the arrangement or restructure the arrangement so that it fits within one of those exceptions. For example, if there's cash held in a joint account and we believe it's a bare trust, well, if the value of that account is 275,000, well, maybe we take steps to bring the value of that account below 275, or I guess the exception of 250,000. It's important to note that if the arrangement exists on January 1st, 2025, and there are no exceptions available, then that arrangement needs to file for all of 2025, basically. So if we're looking to wind up an arrangement, we want to do so and ensure the arrangement is wound up prior to the end of this year. Okay. Obviously, we want to think about the reasons why we set up the arrangement in the first place, and we wouldn't want to frustrate any of that planning by trying to avoid tax filing. So definitely something to consider and to speak with your advisors on. And with that, we've got about 2 minutes left. So if there are any burning questions, feel free to submit them, and we're happy to answer them. Otherwise, we'll leave everyone to the rest of their lunch. You'll see on the slide here that we host monthly webinars on topics similar to the topics today. They could be tax, accounting, or related to any other matters. If you follow our LinkedIn, you'll get kind of reminders on what our next webinar would be. And obviously a link to register for those as well. And then we do have replays and snippets on our YouTube channel as well.
Doesn't look like any questions are in. There is links to the YouTube channel, like Spencer had mentioned, and our LinkedIn page that has been put in the chat there, if you want the direct link.
Perfect. Well, we'll leave it at that for everyone. Thanks for joining us, and we'll see you next month. Bye, everyone.